Welcome everybody to the latest in the series of webinars being run by us at Moore Kingston Smith. This one is slightly different to any of the previous ones we've run in that thus far we've focused only on issues relating to the UK. But on this particular one, we are going to take on the challenge of trying to explain the various stimulus packages that are on offer in the United States. The US government have taken a very different approach to the UK, and so in the next hour or so, we promise to have a fascinating insight into that radically different look at how things go. My name's Graham Tyler. I'm a partner in Moore Kingston Smith and one of the partners designated in dealing with matters relating to North America. And I'm delighted to say that today, to help us navigate our way through the maze of initiatives, we have the help of our more global US partner, Citron Cooperman. Citron is a nationally recognized top 30 firm in the US with offices throughout the whole country, and with whom we have already developed an excellent relationship and who I'm very happy are able to join us today. They have happily supplied us with 5 of their best and brightest talents. It will be interesting to see with the challenge of the technology we've had in the last half an hour, whether we actually get all 5 of them here, but hopefully that will be achieved. And I will start introducing them to you shortly. For those of you who haven't dealt with Fuse before, which may be a number of you, if you look at the bottom of your screen, there are a series of icons. The icon second from the right is a chat icon. And if you feel like you have any burning questions that you want to ask whilst the speakers are talking, please send that through. Hopefully it will come up on our screens and we'll be able to get the speakers to cover it as they go. Equally, I know that we've allowed some time for question and answers at the end of this presentation. We'll happily take anything extra at that point. So I'm delighted to introduce the first speaker, who is David Seiden. David is the leader of Citron Cooperman's state and local tax practice, hence SALT, for those of you who didn't get it, and it took me a while. He brings more than 25 years expertise to all areas of state and local tax, and also has a huge array of other knowledge in relation to banking, hedge funds, broker deals, franchising, etc. So over to you, David, please, to lead us through state and local tax issues.
Thanks, Graham, and good afternoon, everyone. I hear feedback. Does everybody hear the feedback?
I think if people mute their microphones who aren't speaking, then you'll lose the feedback.
If everybody can mute, there I got it. Everyone's done much better. So first of all, Graham, I thought you said I had 5 years of experience. Let me say
No, it was 25, I think, 25.
And it's probably over 30 at this point. So yeah, so I've been around the block a few times. So I'm David Seiden. As Graham mentioned, I'm the partner in charge of Citron Cooperman's state and local tax practice. It's a pleasure to be speaking with everyone today, and hope everyone is safe and healthy given these insane times that we live in. To start with, typically I like to begin up these types of presentations by telling a joke. The problem is that I've learned that UK humor and US humor is very different. I figured this out a while ago after probably watching various Monty Python movies numerous times, and you know what? I did not find them funny at all. And then I've learned since that you folks in the UK don't really like Seinfeld, the TV series, and I just love that. Now, actually, it's not really true about Monty Python. There was that one scene in the Holy Grail where the Black Knight had his arms and legs chopped off, and he goes, "Oh, come on, it's a mere scratch," which I did find quite humorous. Anyway, in the interest of world peace, I'm not going to tell a joke right now, and we're going to move on to the awesome topic of state and local taxes. So I wanted to give you a sense of what's happening in the world of state and local by asking a question. What is the current status of state and local taxes? And I provided you with 4 answers. Obviously, from the choices, what I can tell you is the answer is D, and the current status is it's a mess. So why is it a mess? Well, there are a number of reasons. Number one is that, and rightfully so, the state's attention has been 99% focused on COVID-19 response. And unlike the federal government that can print money, states aren't allowed to do that. So they have to have the money in order to buy masks and ventilators and do all this kind of stuff. And right now they've spent, they're in debt. So right now they're spending more money than they have. So the taxes are going to become a much bigger piece of the focus once things begin to settle down. If you're currently under audit, auditors are working from home, and here in the U.S., state auditors barely work when they're in the office. So to have them working from home, nothing gets done. One of the other things that's happening is that there were a number of provisions that you're going to hear about that just were enacted through the CARES Act, which was done at the federal level. And depending on certain criteria, which I'm going to talk about in a second, not every state follows whatever the government says. So states are allowed, so long as they're constitutional, create their own laws. The other thing is there's so many different taxes that state and local governments administer, whether it be income tax, sales tax, property tax, payroll tax, and trying to keep up with the current COVID-19 extensions and trying to help small businesses. Every state is making up their own rules to try to help our clients figure out when their payments are due, which payments can they hold on to for a while, is in itself a full-time job. So what effect does the CARES Act have on SALT? Like any good attorney in state and local tax, the general answer is it depends. And it depends, like I mentioned, because there's 50 states and 5,000 local jurisdictions that impose some version of a tax. The version is keyed off of the Federal Internal Revenue Code. Most states, when it comes to income tax, start with taxable income as reported to the federal government. Then, depending upon which version of the code and which acts they've adopted, there's modifications to that starting point. So just in its simplest, rolling conformity means that a state starts with federal taxable income based on the most recently adopted Internal Revenue Code. And in this case, it would also include the provisions of the CARE Act. Static conformity is that a state enacts the code effective as of a certain date. So any acts or changes to the code after that date are not incorporated into their statutes. A good example of that would be California. They've enacted the code that was in effect as of 1/1/2015, so any changes to the Internal Revenue Code after that date are not included. So any of the CARE Act provisions that affect the Internal Revenue Code, California did not adopt. And then there's a couple of states that have what we call specific provisions, which don't adopt the Internal Revenue Code, they just adopt certain provisions. New York, I want to give you an example, and New York is very complicated because they have historically been a rolling conformity state, meaning taxable income was always determined based on the most recent code. However, based on what just happened with the CARES Act, they broke it into half conformity, half not conformity, because they did not adopt it for individuals. With respect to corporations, the big three items from at least a state and local perspective that affect taxable income was qualified improvement property. Again, you're going to hear about each of these things. The interest limitations under 163J, and now the ability to carry back NOLs. So starting at the last one, the ability to carry back NOLs, New York does not follow the NOL rules for federal. They have their own. So the CARES Act provision regarding NOLs had no effect in New York. The 163J limitation, New York specifically carved out and said, for the next 2 years, we're not going to allow the additional interest expense provided by the CARES Act. And then finally, qualified improvement property, which is really a technical correction, and I think Paul's going to speak on this, where they just changed the life, which made it them to allow them to have bonus depreciation. Well, New York doesn't permit bonus depreciation. So the fact that they went ahead and did this for federal, again, does not impact it. Now, there's 42 other states that impose net income taxes. So any of these rules that I'm saying for New York can be totally different in the state that one of your clients might be in. And that's why it's very important to determine what the effect is on the CARES Act going forward. Last point on the CARES Act was just because these are the rules today, states, because of the COVID-19 and everything else, they're so busy, have not had the chance to really digest what these rules and how they affect the particular states. So it is very likely over the next 6 months, there's going to be legislation at the state and local level to either adopt or decouple from the CARES Act. My guess is any of the benefits that were provided for under the CARES Act to help companies, states are going to decouple from, as a guess, because they're going to be so desperate for money. And so any of these benefits is obviously going to create a greater revenue shortfall, and therefore, in my opinion, you're going to see a lot of states decouple from a lot of these more favorable things that were enacted at the federal level. Again, California is a static conformity, so none of the provisions apply because none of the CARE Act provisions are now incorporated into California. Now, that doesn't mean that California can't specifically adopt a provision within the CARES Act, but again, California, like a lot of the states, has been hit hard by COVID, and therefore, my guess is any of the beneficial ones, they're just not going to adopt. So there's 5 key takeaways. First of all, I need you to understand each state is different. So to really understand how it impacts your clients, you have to decide, okay, what are my clients' major states, and how is it going to affect them? And it has to be done on a state-by-state basis. The answer on whether they adopt the provisions or not can absolutely be different from a business perspective or an individual. And the example I gave you was New York, where in New York they adopted it for corporations, but they did not adopt it for individuals. Rolling conformity doesn't mean full adoption. So again, a state may have rolling conformity, which means they've adopted the CARES Act, but over the next 6 months, they very well could say, you know what, we're going to make a statutory modification, and therefore it doesn't apply. The final piece of this is you have to be careful when looking at carrybacks, because while it is permitted now under federal law, in certain states, if you carry back it for federal, most states don't allow carrybacks. Let's start with that. But even those that do, if you carry back for federal, you may very well lose those losses from a state and local perspective. So it's very important when evaluating whether or not to file a refund carryback to evaluate the states that might be affected by the amended return. The last slide for me is I just wanted to touch upon real quickly again all the different things that are going on. A lot of them have to do with the constant changing in due dates, trying to help out businesses that have bigger problems right now than filing specific returns, understanding what to do with withholding, what to do with employees that are now stuck at home. Does it create nexus and now a filing obligation for a business because they have people located in other states? A number of states, I don't want to say many, a number of states have come out and said if you have an employee that is working remotely due to COVID-19, that doesn't create a filing responsibility for the business. But that's only been addressed in a handful of states. We'll see what happens. And then the last one is statutory residency for individuals. I just had this issue this morning. Taxpayer is stuck in a state where he'd never been a resident because he never spent 183 days. He wanted to know if there was going to be an exception. Right now, the states, again, are busy doing other things. They've not addressed it. Maybe some states will, maybe some states won't. With that said, I'm going to punt it over to Jamie Reichert, who's a director in the state and local tax practice in our Philadelphia office, and just an ordinary, wonderful, great guy. Jamie, to you.
Thank you, David. Pleasure. Hello, everyone. Good afternoon. Hope everyone is doing well and staying safe. David talked about a lot of the different state and local tax aspects from the standpoint of, conformity with some of the federal changes, as well as a lot of things that we've had to deal with from due dates to payment deferrals and things like that. What I'm going to talk about briefly is the notion of different financing and potential incentives available to businesses from state and local governments. You're going to hear a little bit later about some of the federal benefits, specifically the SBA programs, which really are the major chunk, but certain states and localities have been more proactive than others in coming up with different programs, whether those programs are grants to businesses that have suffered or low interest loans, loan guarantee programs. There's been a host of different things coming out. And the key part is, sort of to pay attention, stay apprised of all the different changes, because these programs are coming open and going live one day, and then they're literally closing, later that day or the next day, because there is so much interest from business. So some examples of some of these programs and some of the offices that, Citron has locations in are as follows. In San Francisco, there is 0 to low interest loans of up to $50,000. Los Angeles has a low interest loan program as well. The state of California has an emergency loan guarantee program. The state of New Jersey as well has loan guarantees for entrepreneur grants to certain emerging technology companies, as well as loan guarantees to small businesses that have suffered as a result of COVID-19. And some of the different things that we're seeing in addition to loans and loan guarantees is obviously there is a need in certain states and localities more than others for additional protective equipment and medical supplies as a result of the coronavirus. And there are certain localities and states that are providing particular incentives for the manufacturing of those items. Particularly Connecticut and Maryland are providing grants to manufacturers that create those products, or manufacturers that pivot their own manufacturing programs to be able to create those products. Another thing that I'll mention is we expect to see additional activity as the states and localities come back into legislative session. So for instance, right now, just taking a look at some of the key states, I'm already seeing legislation for new grant programs, legislation to add on to current manufacturing and investment tax credit programs in the state to cover particular COVID-19 businesses. And, part of what we think is going to happen from sort of a national trajectory and what we see from both the federal as well as state and local is we think that there's going to be a renewed interest in manufacturing in the United States and creating more products in this country. And as a result, we can foresee potential new federal tax incentives. And what I mean by federal tax incentives is there's a host of different tax credit programs that are available, specifically some of which are new market tax credits, which provide tax credits of 39% of the investment in particular projects. That would go really nicely with manufacturing, as well as work opportunity tax credits, as we call it WOTC, to cover potentially people who have been unemployed or put on furlough as a result of the COVID-19 disaster. So those are just two examples of federal programs that we can see potentially being amended to cover this current situation. At the state and local level, we also have a host of different benefits ranging from tax credits that can be used against, entity level taxes.
I think we may have lost Jamie briefly. Should we give him a second to see if his technology comes back, or we will move on without him, but we'll give him a second first. Actually, while we're waiting for him, David, one of the things I jotted down during your presentation, if you can clock back in, is whether, in view of what you say about the states running out of funding, whether you believe that they're likely to take an aggressive position on tax increases and collection once this starts to end.
Can you hear me?
Yeah, I can hear you.
Okay, great. Well, I do think that, first of all, there's going to be such a backlog of cases. They're not opening many new cases. And given there's going to be a mandate that two things are going to happen. My guess is they're going to want to close old cases, which could work in our client's favor. But I do think they're going to be aggressively starting new cases. So because of just the pure need to generate revenue, I think it's going to be some time, months before any of this is figured out at the state level as far as those types of things. We're still trying to figure out filing deadline dates on all the various taxes that they administer.
Okay, no, that's helpful. So I haven't seen Jamie reappear, so maybe we will move on and let Jamie clock back in at some point.
Can I just, Graham?
Yeah, sure.
Let me just close the loop on Jamie's part.
Thank you.
Jamie and I have felt very strongly that this is going to, over the next year or two, because of the what's happened because of the COVID and the current president, Made in America, is going to create a fury of companies looking to make investments in the United States. And it's going to become very competitive, even more so than it is now. And it's a great opportunity for companies that are considering it to make sure that up front, because credits are they're most valuable when you negotiate them before anything is signed. So if you have clients that are considering over the next year to be making investments in facilities in the United States, it's now and over the next few months is the time to start looking at that, because once they're already way down the path and they've either identified a piece of land or a building, a lot of the leverage is gone in the discretionary incentives that most jurisdictions provide. So just keep your eyes open, your ears open, speak to your clients that if they are interested in possibly expanding their presence here in the U.S., now over the next 6 months, 3 months, whatever it is, would likely be a great time to do it.
Okay, no, that's great advice. Thank you. If we're happy, we'll move on to Mitzi Hollenberg, who is a partner in the Citron, Rhode Island office, and who is going to cover the payroll protection program, which has obviously been the source of much debate. So, Mitzi, over to you.
Great. Thanks so much, Graham. And I just wanted to, explain a couple things with regard to the economic stimulus packages that the federal government has put out there. Namely, the one that you've probably heard the most about is the payroll protection program. That is a program where it really is designed to keep the employees who may otherwise not be able to work right now, to keep them employed. And it's really a program by which the federal government is infusing money into what's considered to be a small business based upon certain size standards, such that those businesses are able to keep employees and keep paying them for a certain period of time. If they do as requested by the federal government with regard to these funds, those funds can actually be forgivable by the federal government and not turned into a loan. In the event that they're not forgivable expenses, they are turned into a loan at 1%. So you may have heard, quite a bit on the news with regard to this program because it's constantly evolving. And this program was created by the CARES Act on March 27th, 2020. And since that date, we've had 2 different interim final rules that have been issued to try to clarify provisions of the program. We've had 3 or 4 different frequently asked questions that have been issued by the SBA and by the federal government and Treasury related to this program. And as you probably heard or saw, if you're paying attention to the news over in the US at all, the program ran out of money after a short period of time of only 20 days. So the initial funding for the program was $349 billion. And the goal of the program was really to get the money into the hands of small businesses, which are determined based upon the Small Business Administration's definition of size standards. Typically, it's going to be, in most instances, those are businesses with fewer than 500 employees. There were exceptions which have been made notable based upon the news that you will see. Certainly Ruth Chris's Steakhouse, Shake Shack, some of these other larger franchises and restaurant groups, they had an exemption really based upon the number of employees that those individuals had in any one location. Therefore, that's why you see some of these larger businesses actually qualified for these small business loans. Again, the loan was designed with the intent to really provide ongoing business operations through preservation of payroll. And so these larger businesses and smaller businesses that are eligible are able to apply with their local bank in order to have a loan that will be coming forth from the federal government to support these particular causes. So, with regard to the audience, I want to make sure that people are aware that you can use and you can apply and potentially be eligible even if you are a foreign company, but you have a U.S. branch and U.S. operations. So this can be used for companies who are eligible because their employees have a principal place of residence within the United States. You also can qualify if you are a business located in a foreign country, as long as you have a principal place of residence in the U.S. Non-resident aliens are allowed to have a company or own a company in certain instances that have an operation or a branch within the United States. They can still potentially qualify for eligibility. There are affiliation rules with regard to how big is one of these companies in terms of typically, again, the 500 employee rule. If you own or control other entities, whether they are US or non-US, Those are all considered in determining your size determination as to whether or not you're under, again, typically the 500 employees for purposes of getting one of these loans. So again, in order to do so, one of the certifications as well is that you have to operate primarily within the United States, or you have to make a significant contribution to the U.S. economy. And that can be either through taxes, use of American products, materials, or labor. On the application itself, you do make a certification that says that you will be contributing as best as possible, use American resources at all times, whether or not it's feasible. Certainly that's something which is a certification that you have to make in order to apply and be eligible for one of these loans. So the basic premise of the loan program is that you calculate the maximum loan amount based upon 2.5 times what your payroll costs are. Your payroll costs cannot include foreign employees. So this, again, is really related to your domestic employees. And the definition of payroll is, not just limited to gross compensation. It also includes things like your health insurance benefit for those employees, your retirement benefits. It's different if you're a sole proprietor, or a single member LLC, or you happen to be a Schedule C business. The calculation can include some guaranteed payments of partners and partnerships. And it's a little bit different, but overall, the bottom line is you take your monthly payroll and you multiply it by 2.5. And that will be the maximum loan amount that you're allowed to obtain during this program. And then you have covered uses. So once you receive your first disbursement of these loan funds, you pretty much have 8 weeks to use them as it stands right now. And again, the guidance is constantly evolving, and we haven't seen any guidance issued from Treasury yet or the SBA with regard to how you would document these covered uses for purposes of forgiveness. But typically this money is allowed to be used for 8 weeks of payroll expenses. It's able to be used for any rent obligations that you have, any interest on covered mortgages, and any utilities during this 8-week time period. So again, if you actually follow the rules, and as the forgiveness guides are kind of put out there and we have a little bit more information on it, you can apply with your bank for potential forgiveness of the loan. And the loan forgiveness is going to be based upon the fact of, did you actually keep your workers retained? So you're going to do a calculation that's, what did you actually spend for covered uses of this payroll? How many employees did you have prior to the COVID-19 crisis? How many employees did you have during the covered period? And how many employees do you have now? And based upon whether or not you were able to maintain those levels of workers will determine a percentage of reduction in your forgiveness. So for example, if you laid off 25% of your workforce, and just to make it simple, you had a loan for $1 million, you spent $1 million on covered uses, but you reduced your workforce by 25%, you'd only be potentially eligible for $750,000 of forgiveness. Anything that remains has no payment on it for the first 6 months, and the remainder has a 1% interest rate, which accrues during the entirety of the loan period, and the amount is actually due in 2 years. So as I mentioned, this program ran out of money within 20 days. It was on a first come, first served basis. What has happened yesterday and is constantly evolving is the Senate has passed an appropriations bill, which really is going to expand the Paycheck Protection Loan Program. Doesn't really change the program based upon the text that we read coming out of Washington, but it's going to allow for an additional $310 billion of paycheck protection loans under this program. That is actually going over to the House, and the vote is expected on Thursday for the additional funding for this program. And we'll see what will happen, because there's certainly some political movements, as always, with regard to the fact that many small businesses appeared to be unable to get loans under this program with the first round. And so there's a lot of conversation from the House side and the Democratic side of trying to make sure that this money actually goes into the hands of the small Main Street businesses. That being said, as I mentioned, Main Street, I'll talk about some of the other programs that exist in the CARES Act with regard to economic stimulus for some of our business clients. So the SBA has always had this program available for businesses. It's called the Economic Injury Disaster Loan Program. And typically, you'd see this after maybe a flood or an earthquake or some other federally declared disaster in a federally declared disaster zone. What's happened with the coronavirus is the entire country has been declared a federal disaster for purposes of the economic injury disaster loans. So anybody who's been adversely impacted by COVID-19 is able to apply for the SBA's economic injury disaster loan program. These loans were, and I say were because similar to the Paycheck Protection Loan Program, this program has also run out of money. This one ran out of money faster than the Paycheck Protection Loan Program. And the SBA was saying that they really were processing about 17 years worth of applications in the span of about 2.5 weeks, which they've never had come through as loan volume, really. So this is a program that's really administered directly by the SBA, and it allows for a working capital loan up to $2 million. This is a non-forgivable loan. It's really just a federal loan where you'd have an interest rate of 3.75% for for-profits and 2.75% for nonprofits. These loans are actually due in 30 years. They originally were to be, up to 30 years, but they kind of have been all rolled into a 30-year loan. These are things typically to be used based upon a demonstrated need for working capital, paying your payroll, paying your AP, paying your line of credit, things like that you need to actually pay, and based upon economic necessity. And again, these SBA size and affiliation rules exist for these companies. Again, if you're a U.S. branch, you can qualify potentially as long as you're not over both the employee count and the revenue count based upon your industry. The next program that has been really brought to fruition or expanded through the CARES Act are the Main Street loans. And these are really designed for those medium to large size businesses where borrowers who have up to 10,000 employees or up to $2.5 billion in revenue can apply for these loans. Again, you have to be a business created or organized in the United States or under the laws of the United States with significant operations in and a majority of employees based in the US in order to qualify for these Main Street loans. Based upon your EBITDA, your existing debt facilities that you have on your books and records, you will have a limit on the amount that you can borrow. Your minimum loan under this program is $1 million. But once you sign these loan agreements, you are signing some control over to the federal government with regard to restrictions on compensation, stock repurchases, distributions, not only during the period of the loan, but for 12 months following the repayment of the loan itself. And the expanded Main Street loan facility is just an expansion for those who may have already applied for or qualified for Main Street loans in the past. So that being said, there's a lot going on. As I mentioned, the EIDL loan program ran out of money. In this potential new bill, there's another $60 billion that's been set aside for the EIDL programs. There was a $10,000 advance grant that was available under these programs. That dried up pretty quickly, and then the rules changed on that to limit that to the number of employees times 1,000 up to a maximum of $10,000 for this advance grant. One piece that I didn't mention with regard to the PPP program, the previous slide, is that if you do qualify for loan forgiveness, specifically in the CARES Act, that forgiveness of debt is not considered to be income for federal tax purposes. So again, like the state programs that exist, the EIDL, the Main Street loans, the PPP loans, they're all constantly evolving, and the goal is really just to get money back into these businesses to keep the economy going. So that being said, I'm going to turn it over to Paul Daly, who's going to talk about the Family First Coronavirus Response Act, Section 139, the CARES Act tax provisions. So Paul, I want to make sure that you're on.
Hello, everyone. Can you hear me?
Yes. We can hear you, Paul.
Thank you so much.
Perfect. All yours. All yours.
Thanks again. Great. It's a pleasure to be here. And again, as everyone said, hopefully all is safe and healthy. And again, this is very exciting for us to be working in cooperation with this. And it's a great outing. Thank you. I'm going to start in terms of the tax acts, more domestic. The first is the Families First Act. This was kind of revolutionary in a way, in that it was the first mandated federal mandate that employers provide paid sick leave to employees for COVID-related needs. It was also expanding the Family Medical Leave Act. It's expanded to include a paid leave compensation for employees caring for children whose school or credit care facilities were closed because of virus unfortunate incidents. It also provides for a payroll credit to the employer. There are still many questions, even though it's been around, unfortunately, now for a good month or so. The key takeaways: it's a paid sick leave for workers. For COVID-19 related reasons, employers receive up to 80 hours of paid sick leave and expanded paid child care leave when employees' children's schools are closed or child care providers are unavailable. Complete coverage, meaning that employers receive 100% reimbursement for paid leave pursuant to this act. Health insurance costs are included in the credit, and employers face no payroll tax liability. There are various, on the emergency sick leave, there are various categories of employees. You'll see there are 6 categories where this applies to various employees, that the employee is subject to a coronavirus quarantine or isolation order, and you'll see the various categories. The notice is a notice 2021, which provides that the credit qualified sick leave wages and qualified family leave wages required to be paid by this act will apply to wages paid for the period beginning on April 1st and ending December 31st, 2020. For the various paid sick leave, private sector employers are covered with fewer than 500 employees. A covered employer in terms of attribution, this basically, the Department of Labor has basically stated that any corporation is considered to be a single employer. But where a corporation has an ownership in another corporation, the two corporations are separate for the purposes of the Act unless they are joint employers under the FLSA. If they are determined to be joint employers, and all jointly employed employees count towards a 500 employee threshold. There is also a de minimis test that the Labor Department was granted authority under the measure to exempt employees with fewer than 50 employees from the requirements to provide employees with paid sick leave related to COVID-19 if the employers can show that granting such leave would jeopardize the viability of the business as a going concern. The basic thing is that you get, the employer will get a credit to the payroll taxes that is being paid, and the employees get the sick leave. Basically, it's a maximum. It's for 80 days. It's a maximum of $5,110, cannot exceed $511 per day, or the amount of sick leave provided by the 4th and 5th categories, because of the various 6 categories, cannot exceed $200 a day or $2,000. In addition, there is the FMLA expansion. After 10 days of unpaid leave, a period of paid leave would follow for employees who need to care for children younger than 18 whose school or child care facility is closed because of the virus, or whose child care provider is unavailable because of the outbreak. Whatever sick leave now is being paid under this act will be a credit for the employers in terms of payroll taxes. It will go against their employer, what's called their employer portion, the 6.2% payroll taxes. They will not have to pay that. They will get a credit for that. There are various ways in terms of maximizing that. They can reduce their payroll tax liability, or they can file a form, what's called a Form 7200. If they anticipate that they will have more credit than payroll taxes, they can receive a refund, or they cannot also, they will not be charged with penalty for not paying payroll taxes if they anticipate this credit and apply that against the payroll taxes to be applied. The provision also applies to self-employed individuals as well that will be in a similar situation. Any payroll taxes that are paid would be, in terms of a refund, would be considered income, so there will be no double benefit in that the deduction will offset the income. I'd like to now, you'll see in the various other charts, the slides of various charts that would be in terms of going forward. You could certainly take a look at that. I now would like to then turn to section 139, if I may. If you could turn that slide, please. The next slide, if you could continue to go to a couple next slides. Sorry for that, one more. Another one. One more. Thank you. Section 139. This is a tax-free benefit provision where, in terms, it was enacted under this 9/11 disaster terrorist tax to provide tax-free benefits for disaster-related situations. To the extent that an employer pays for various expenses to the employee, they would receive a deduction and it would still not be included as income. So it is a tax-efficient assistance to employees impacted by COVID-19. It relates for reasonable and necessary expenses resulting from the coronavirus pandemic. This is now certainly considered a disaster emergency, so that by the announcement by the president, this is now satisfying the requirement of Section 139. What does it cover? Section 139 covers various reimbursable expenses that are related with the coronavirus. Unreimbursed medical expenses, including copays, deductibles, vitamins, supplements, increased expenses associated with being quarantined at home, such as increased utilities and home office expenses. Expenses associated with setting up or maintaining a home office, such as enhanced internet connections, computer monitors, laptops, printers, housing for additional family members, non-perishable food purchases, increased child care expenses, expenses to enhance mental health and physical well-being from social distancing, such as meditation apps and home health fitness, and alternative commuting means in lieu of mass transit. The non-reimbursable expenses do not include payment for expenses that are not reasonable and necessary, and that payments that constitute an income replacement program, such as payments for lost wages or lost business income, and also payments that are reimbursed or reimbursable by insurance or otherwise. There is no expense substantiation, which is quite rare in terms of U.S. required tax documentation. There is no dollar limit, no discrimination testing in terms of highly compensated employees, no payroll taxes or reporting. You don't have to put out what's called a Form W-2 or a Form 1099. Again, there is no deduction limitations, but there would be a limitation of double benefits, and that a self-employed person that does qualify would not be able to take benefit of this. It could be in the form of a cash advance as compared to a reimbursement. And again, there's no plan documentation required, no written plan, although we do advise employers to basically have some type of program where the employee would represent that this is an expense relating to COVID-19 that's deemed reasonable, at least to have some supporting documentation. Again, it's really relating to providing benefits to employees during this situation, and to the extent possible, although it's certainly difficult now for employers to be making payments, this is a nice way in terms of making this payment in a tax-efficient way. Again, to reiterate, it's a tax deduction for the employer and not to be reported as income by the employee. With that, I would like to go to other various provisions of the CARES Act. If you could move the slide, please. Thank you. These are the business provisions. And we've been discussing this. David has been talking about the various state ramifications, and Mitzi has been talking about the PPP. These are the various tax provisions that I would like to discuss. The first is in terms of the charitable deductions. Corporations are limited to 10% of taxable income as a charitable deduction. For 2020, that has been increased to 25%. The refundable employee retention credits. These, again, are various incentives to try to have employers continue to employ individuals. The first is in terms of this refundable employee retention credit, where an employer can receive a credit up to $10,000. It's limited to $10,000 of wages per employee. It's 50% of the qualified wages paid by an employer after March 12th, 2020, and before January 1st, 2021. 50% of the qualified wages, so that the maximum credit would be $5,000 per employee. This is not eligible for anyone, as what Mitzi was been discussing with the PPP. Anyone who has a loan or applies for that, anyone who applies for it would not be entitled to the employee retention credit. How it works in practice is that it basically looks to the number of employees that you would have. If you have less than 100, please hold on one second, excuse me. For those with more than 500 employees, it does not qualify. If you have 100 employees or fewer, then it certainly could relate to your situation. To the extent eligibility for the credit is determined on a quarter-by-quarter basis, in order to be eligible for the credit for a given quarter, you must have carried on a trade or business during the year 2020, and either the operation of the trade or business is fully or partially suspended during the quarter due to a governmental order relating to coronavirus, or the trade or business experiences a significant decline in gross receipts for the quarter. A significant decline in gross receipts during the quarter is determined if its gross receipts for that quarter are less than 50% of those for the comparable quarter of the prior year. It's then treated as continuing to have a significant decline in gross receipts for subsequent quarters, continuing through the end of the first quarter, in which its gross receipts are more than 80% for the comparable quarter of the prior year. So again, this is a credit against your payroll taxes. For an employer with 100 or fewer average full employees in 2019, the qualified wages used to calculate the credit are all wages paid during the period that the operation of the business is suspended or during which there is a significant decline in gross receipts, regardless of whether the employee is actually working. For an employee with more than 100 average full-time employees, the employee, it's only if the employee is actually working, meaning that qualified wages include only those paid to employees for times not spent working, and only if such wages are equivalent to the period before the period at issue. Again, it's important to note that you can also apply for quick refund on this form that I was mentioning, Form 7200 before, in terms of the Family First Coronavirus Act, to get an enhanced refund, quicker refund. And to reiterate, it does not apply to the extent that you had applied for a loan under the PPP. Another provision is a delay in payment of employment taxes. An employer may defer payment of its share of payroll taxes for the period beginning on March 27, 2020 and ending on December 31st, 2020. 50% of the payroll taxes of this period are now due on December 31st, 2021, and the remaining 50% would be due on December 31st, 2022. The deferral only applies to the employer's share of what's called the OASDI taxes, which are generally 6.2% of wages. And the employers still must continue to pay their share of the Medicare taxes, which is really generally 1.45%. The Act provides comparable benefits to the self-employed individuals. If you may, can you just move the slide, please? Thank you. Allowing them to defer up to 50% of their OSADI self-employment taxes at a 6.2% rate for the same period. So this does apply to partners. It is interesting that a taxpayer could use this even if they applied under the PPP. There was a question as to whether, because the way the law reads is that you cannot use this deferment of payroll taxes to the extent that you had a loan forgiven. So there was a question as to whether you applied, and hopefully everyone is looking that their loan would be forgiven. If it wasn't forgiven, then clearly you would be able to use this delay in payment of employment tax provision. If it was forgiven, the question was, when would you be able to do this? Would it go back to day one or only at the time that the loan was forgiven? There was a recent IRS announcement that clearly stated that you could do it, and that once the loan is forgiven, then you could no longer defer payroll taxes, but the payroll taxes could be deferred up until the time of that forgiveness, and then they would be due the periods of December 31st, 2021 and 2022. There are various other provisions in terms of modifications for net operating losses. As revised by the TCJA, losses could only be carried forward, and they would only be limited to 80% of taxable income. The new law under the CARES Act basically suspends this provision and does enable one to carry back, and we're seeing a lot of activity in this in terms of net operating loss refund positions. The new law, again, for now allows net operating losses arising in 2018, 19, and 20 to be carried back for 5 years. In the case of net operating losses incurred in 2018 and 19. This obviously can give taxpayers an opportunity to obtain refunds within a fairly brief period of time. The taxpayer, to the extent possible, to the extent that they would want it, they can, as under old law, elect to forego the carryback. In terms of the NOL refunds, again, we're seeing a lot of activity on this, and it is what's called a quickie refund, where if you do it on a specific form, a 1045 for an individual or 1139 for a corporate company, you could basically should be able to get your refund within 90 days. It's what's called a quickie refund. Because of the deluge of various refunds, as you can anticipate, the IRS is now accepting it to be faxed to them as compared to mailed. So hopefully, again, this can expedite the people getting refunds. And to emphasize also that the Act removes the 80% limitation with respect to the use of net operating loss carryovers beginning before January 1st, 2021. So those losses would be allowed 100% against any type of future income. There was also, in terms of losses other than net operating loss, there was a loss basically for non-corporate taxpayers, where in terms of an excess business loss, they would only be able to deduct $250,000 if single, or $500,000 in the case of joint return filers, against their other investment income. And this provided for various limitations. The Act revokes this limitation for taxable years beginning before January 1st, 2021, and leaves it applicable only for taxable years beginning after December 31st, 2020, and before January 1st, 2026. So taxpayers who were limited under this, again, now have the opportunity to file amended returns. To the extent that generates a loss, which we're seeing in many situations, they could then carry that back 5 years to 2013. The Act did clarify that wages should be treated as non-business income for this purpose. Also, there was an interest limitation, what was known as Section 163J. There was a 30% limitation of what's called adjusted taxable year. Under the new Act, for taxable years beginning in 2019 and 20, 50% rather than 30% of ATI, adjusted taxable income, can be taken into account as compared to the 30%, except in the case of partnerships business interest expense. They become more complicated in that it remains at 30. However, each partner in the partnership may then treat 50% of the share of the disallowed business expense as a deductible expense incurred in 2020. Also, any taxpayer may elect to treat that taxpayer's 2020 ATI is equal to that taxpayer's 2019 ATI for purposes of calculating the 2020 business interest limitation. And we would imagine in many situations, 2019 income would have been higher than 2020. The interest limitation does not apply to what's called a small business company, where their receipts are at least $25 million or less, and that's indexed for inflation during the last three preceding years. It also doesn't apply to electing real property trades or businesses. And that election had to be made timely. By doing that, and that's a real property trade, you basically have a toll charge where you have to stretch out the depreciation deductions on what's known as the ADS, or alternative depreciation system. That election had to be timely made, but now because of the new limitations and also what I'll be talking about in terms of qualified leasehold improvements, you now can go back and make or revoke an election that you might have made in terms of the electing real property trade or business. Another change that was made, again, to enhance liquidity was the enhanced depreciation for qualified improvement property. Could you change the slide, please? This was basically a correction to a glitch. It was known as the retail glitch. When the TCJA came about, it gave an 100% bonus depreciation. That was also supposed to apply to what was called qualified leasehold improvement, which was leasehold, retail, restaurant improvements, and the like. During the glitch in the law, unfortunately, it was a pure drafting error that the leasehold improvement property was given a class life 39 years, and therefore they were not qualified for bonus depreciation. That has been rectified and changed under the new law. Basically, it's a technical corrections, which would now allow one to take bonus depreciation on qualified improvement property. It is retroactive. It does go back to property placed in service after December 31st, 2017. Very quickly, qualified improvement property is any interior improvement to non-residential real property, includes lighting and exit signs, does not include enlargement of a building, elevator or escalators, or internal structure framework of a building, can include non-structural improvements to common areas of a building. Refund potential thus is certainly possible, and as Dave mentioned, the various states have different treatments of qualified leasehold improvement. The state ramifications must be looked at. What was interesting in the law was that they did clarify that qualified improvement property, QIP, only includes improvements made by the taxpayer. This is a clarification in the Fair Cares Act, and basically will probably rule out any bonus depreciation for used qualified improvement. And then, if I may, just to conclude in terms of the individual provisions, you'll see that you do have the various in the slides. There was a recovery rebate, which has been talked about a lot. It does depend upon the AGI, adjusted gross income levels, and that has been going out. The IRS does have a website that hopefully facilitates people getting that. To the extent that you filed a return in the previous year will be based on that. The information will either be used to have a check mailed, or hopefully more importantly, you would be able to use a bank account. You can use this IRS website to update that. And if you have not filed a return, you want to require to the Social Security should work, and you should get the Social Security statements. You should get the rebate based on that. There is also facilitation in terms of retirement plan distributions, where you can take out up to $100,000 during 2020 without penalties. Any distributions can be repaid within 3 years and will not be subject to taxation. Amounts not repaid will be included in taxable income over a 3-year period. And in lieu of distributions, loans of up to $100,000 from the plans may be taken. There was also an enhancement of charitable deductions, where you now can take a $300 above the line deduction. And for itemized, it's a 50%, the 50 or 60% adjusted gross income limitation charitable contributions has been suspended for 2020, which would enhance, hopefully, more charitable deductions. And lastly, the employer payment of student loans can now be excluded from an employee's income, subject to the overall $5,250 limits on employee-sponsored educational assistance programs. This just means that any type of student loan can fall within that $5,250 exclusion. And with that, I'll turn it over to my partner, Leon, in terms of the international provisions.
thank you for the opportunity, Graham and Kingston Smith, today. Clearly, this afternoon, we spent a lot of time going through a lot of details. I'm going to walk through the slides that I put here today. I don't want to gloss over them, but by the same time, there's some very specific information on here that really drives into minutia in some places. But I want to highlight quite a few things. So my goal here is to really raise a level of awareness without trying to inundate the participants this afternoon. So I think first and foremost, when we're looking at how the IRS Treasury viewed everything as things came out, we came out in a very piecemealed approach on some things. Some things were handled very early on and handled very keenly and quickly. Other things kind of bled out and still continue to come out as we go on, as Mitzi had said earlier. So as we're looking at things, what we know today and what we knew a week ago does change. So I think the big things that are really focused on from the compliance side, looking at the deadlines, we had a deadline of April 15th. This is our normal tax day in the U.S. Well, there was a lot of things that were extended early on. For example, the Form 1040 was basically extended to July 15th and payments to July 15th. But some of the things that were attached to a 1040 or an 1120, corporate tax return, were not specifically included. So some of those have been really clarified. So looking at our filing and payment deadlines, anything that was due between April 1st and July, anything due after April 1st and before July 15th is extended for payment and filing till July 15th. Where this really the rubber hits the road from an international perspective, U.S. perspective, is U.S. individuals that reside abroad, our expat community. There's a lot of folks that would generally not have filings that are due until June 15th if they had owed no tax here. So those have been extended to July 15th. Non-resident individuals, non-resident aliens of the U.S., people with real estate investments, companies here or whatnot, they're extended to July 15th from June as well. And then U.S. or foreign companies that have no U.S. office or presence have also been extended to July 15th. Keep in mind that returns that get filed for corporate claiming treaty positions on June 15th, foreign corporations generally are also not required to file until July 15th. The additional clarifications that came out is the 3520, 5471, and some other forms, 8865. Those particular forms generally are filed with another tax return, again, 1040 or an 1120, for example, but not always. 3520 and 8865, 3520 is a foreign trust, 8865 is a foreign partnership under our rules. They can, on certain circumstances, be filed separately. The clarification that came out on the Section 965 transition tax payments, they were also extended to July 15th. So there was uncertainty early on, but that has clearly been moved to July 15th as well. Net operating losses, as Paul Keenly went through, there's very good provisions that came out without reciting too far into what he went through, that with the net operating loss opportunities to be carried back, there's both a compliance aspect and a planning opportunities here from an international perspective. First and foremost, that if a taxpayer had a transition tax obligation in either 2017 or 2018, if we had a refund, for example, carried back or had cash free up in an earlier tax year, that refund under normal circumstances would have been used to offset the transition tax obligations. The rules that were just put out in Revenue Procedure 2020-24 basically allow taxpayers the opportunity to elect to skip the transition years in your net operating loss carrybacks. So that way the cash will truly make its way to the taxpayer. That's one option. The other option is if you truly the taxpayer wanted to reduce their 965 obligations, they still could. But the planning opportunity that exists in here is if you have foreign tax credits, which would be very common for an individual, an expat, if you will, that they could have excess credit because net operating losses normally run before you actually look at your foreign tax credits. So, for example, if in a tax year, assume we carried back a loss to 2013 or 2014, and the taxpayer was overcredited or not overcredited in that year. If we carry a loss back, it's very likely that when the loss is utilized, it will free up foreign tax credits, which could either be carried forward or also carried back a year at that point. So there is opportunity to free up cash or credits otherwise. So these are the slides I'm going to kind of gloss over, but note in here between April 1 and July 15th, there's a litany of forms in here that normally would be just extended on April 15th. But there's a lot of them that fall in here. You could have 1065s due on June 15th. You could have Form 709 due on a different date. And the excise tax payments, Form 990, 990Ts, they could also have different dates. The quarterly estimates are very important in here. I want to draw attention to that if you had quarterly estimates to be made on June 15th, they also now get pushed out to July 15th. It would be an opportunity for cash savings for individuals, cash flow savings anyway. The relief is until July 15th is a specified time, but also too there's sensitive actions that are due to be performed. These things include court petitions and audits, extensions of deadlines, etc. There's quite a few things that have been moved through here that really are going to benefit taxpayers potentially, and or take the stress off of dealing with the operational side of things, dealing with the IRS, because the IRS basically, there's no real answering of phones right now. So any of the things that could have administratively had to deal with, we're dealing with it or pushed back as well. And again, on this slide where I show filing and payment extensions, there's quite a few things that sit in here. Some of the notable ones that I would draw attention to are Section 1031 like-kind exchanges, involuntary conversions, Form 8832, which is check the box election, which is quite often used in the foreign space or the international space with the U.S., 338 elections, 9100 relief, and the last two, kind of sitting at 14 and 15 are pretty important when you're dealing with real estate and operating partnerships in the U.S. that have foreign partners. The Form 8288 is withholding when you have a sale of U.S. real estate subject to our FERPTA provisions. And then the Section 1446 withholding is a quarterly withholding when you have a U.S. entity partnership that would have a foreign partner that's required to withhold on current year profits. So that pushing those back as well is also quite cash flow friendly. Again, covers examinations and appeals and 30-day postponement on time-sensitive IRS actions. So there's been quite a bit pushed through here, and there's a lot of good information, but there's a lot of detail. For a moment, I'm going to go off slides, if you will, because something came out yesterday that I think we'll have something out on this in the next day or so. But yesterday, the Internal Revenue Service came out with two very important provisions, if you will. It came out with Revenue Procedure 2020-20 and Revenue Procedure 2020-27. The first one deals with foreign individuals present in the U.S., and how we're going to look at our day count, if you will, without getting too far into this. It's basically taking the period of February 1st to April 1st and excluding that 60-day period in our day count for the year 2020. So that's one piece. The second part is for U.S. citizens and residents abroad, and that's basically doing the same thing for a number of days. There's a provision in here for businesses that was clarified in an FAQ section, which I thought was very keen, because we basically it's looking at foreign individuals that could be in the U.S. and trapped here because they could not travel, and whether that would create a permanent establishment potentially because of this. And if it was directly related to, COVID travel, then the 60-day period again from February 1 to April 1 is going to be ignored and not treated as potentially detrimental to a business and possibly establishing permanent establishment in the U.S. So with that, I'd like to turn it back over to Graham, and thank you.
Thanks, Leon. And firstly, I'd like to thank all the speakers for doing such a comprehensive job on what is obviously a very complicated package, and we seem to have got through a huge amount of the rules. Also, knowing the kind of problems we have with the technology early on, also thanking them for kind of sticking with it and making sure we got all the way through. I'm keen that we wrap up at about 3:30, which leaves us maybe 5-6 minutes for some questions, if anybody has any. The joy of being me is that maybe I can take one before anybody else sneaks in. In the UK, we initially announced support in relation to salaries and retaining employees up to the end of May, and that has just been extended through the end of June. And I know that the PPP loans are set up on an 8-week basis, and I wonder whether there is any belief that that will be extended beyond 8 weeks. I'm happy for any of you to take it, but it may be most logical for Mitzi, maybe.
Yeah, so I mean, it's a great question, Graham, and it's one that we've really been, kind of struggling with, because a lot of our businesses right now are shuttered under state orders by the governors to not be open. So, we're running into issues between our unemployment insurance boost that's come from the CARES Act that many states are really kind of giving and providing to their employees above and beyond what they typically would get under state employment. So you kind of have this parity, or this disparity, I should say, between employees who don't want to come back to work right now because, one, either they have nothing to do, two, they're afraid to come back to work, or three, it's really just not useful in, when you have a shuttered business. So that certainly has been something that's been talked about, and the AICPA, I know, has been instrumental in trying to lobby Congress to extend that 8-week period, or make the 8-week period start when the businesses are allowed to reopen. I know that just recently, I think it was this morning, the Georgia governor has allowed for, or is starting to open up some of the businesses starting on Friday. So we'll start to see like massage therapists and gyms and, some of the hair salons. And things like that. Yeah, so exactly. So they're going to start opening up, but yeah, exactly. It makes sense with regard to extending that 8-week period, but we just don't have that available right now. There are other credits, within the CARES Act that individual businesses can take advantage of, which may help them with some of those issues.
It's interesting because the provisions here have certainly had some criticism that they haven't worked very effectively. Is the impression in the States that the package is generally a very positive thing? It seems massively comprehensive.
Yeah, I mean, I think the issue is, right, nobody's ever had to deal with a pandemic before, and what do you do when all of a sudden you're shuttering businesses? And, the speed by which the CARES Act was pushed through between the Senate and the House and signed into law by the president was astronomical. So there's a lot of technical corrections that we know that need to happen to that particular law in order for it to really kind of meet its intended use. But I think that everybody is just scrambling right now. All governments are doing their best to try to figure out how to have this response when nobody was prepared for the economic fallout of a pandemic. I think that, the health insurance side and what people are really doing. There's a lot of push, on the in the CARES Act for health-related provisions, telehealth, Medicare reimbursement, advanced payments, things like that for our healthcare organizations, and additional testing money that's been put out there. But with regard to the small mom and pop businesses and social distancing, nobody really knows where this is going right now.
Yeah. I'm happy for anybody else to jump in and put questions in. If there's nothing, and I can see nothing on the chat room, it just remains for me to thank David, Mitzi, Jamie, Paul, and Leon again. Thank you very much for your time, and thank you everybody for attending, and all stay safe out there. Thank you very much.
Thanks.